I think right now what you're describing is a gold revaluation by stealth. It is happening under our noses, and people are not catching it yet.
They aren't catching it. They're asleep.
Yeah, but I agree. There comes a point where right now there is such a shortage because long story short, I still believe that the Fed is suppressing. It is the Fed, the Fed in conjunction with the Bank of England, who is the sole holders of the short positions in the COMEX, which is primarily the COMEX. And because every first-year bank that I know, every first-year bank and every liquidity provider said, no, everyone's long and strong. As soon as Basel III NSFR conditions came in 3 years ago on the 1st of January 2023, everyone went long. So there's only really one entity, or a cartel, a central bank cartel, who is still short. Now, there is such a shortage there's such a mismatch. So can we, just because every bank now, that even the 5 banks that are managing the Office of the Comptroller short positions, technically compliant FX positions in gold and silver, all long for their own books. So it really smells of it can only be these central banks. Now, there's such a shortage and there's such a massive derivative imbalance because you take those OCC bets. So this is what I mean. So yes, by stealth, we are revaluing, but do we wake up on a Monday morning? Because it would happen over the weekend. Do we wake up on a Monday morning and say, tell you what, this is where your COMEX position was on Friday. This is where your paper position. This is why the people you are speaking to must always have physical. And I know this is your thing. Keep physical, only physical, because anyone who holding physical is a winner. But the only losers will be, well, I tell you what, we paper settled that at 3,000. We now think we're going to open up at 3,500. I'm talking about realistic numbers here. Then if you were short on the COMEX, I don't think you would be given the ability to cash settle. I think if you were short, then you would probably, unless you were part of the agent banks who act as proxies for the Fed, you probably, as happened at the Browns bottom when gold was $250, that happened overnight.
In recent discussions, Andrew Maguire, a well-known expert in the precious metals market, has highlighted what he calls a gold revaluation by stealth. This phenomenon is taking place right under our noses, yet most people remain unaware. Unlike past financial shifts, where gold revaluations were openly declared, this time it is happening behind closed doors. Governments, central banks, and major financial institutions are quietly adjusting gold's value in ways that are not immediately obvious to the general public. This revaluation is characterized by a significant mismatch between physical gold availability and the vast amounts of paper gold derivatives in the market. The COMEX commodity exchange, which plays a key role in gold futures trading, is witnessing a growing divergence between paper and physical gold. While the market price of gold is still largely determined by futures contracts, there is a noticeable shortage of actual, deliverable bullion. Maguire suggests that major financial entities, including the Federal Reserve and the Bank of England, are actively suppressing gold prices to maintain control over the monetary system. This suppression is evident in the large short positions held in the COMEX by central banks, while numerous first-tier banks have shifted to long positions since the implementation of Basel III's net stable funding ratio requirements in January 2023. The implication is clear. While retail investors remain focused on stock markets and fiat currency fluctuations, major financial players are preparing for a future where gold is significantly more valuable. To understand the scale of this shift, we must examine the structural imbalance between the physical and paper gold markets. For years, gold has been traded primarily in paper form through futures contracts, exchange-traded funds, ETFs, and other financial instruments that represent claims on gold rather than actual ownership of the metal. The issue with this system is that it has created an illusion of excess gold supply. In reality, the total amount of gold available for physical delivery is a fraction of the volume traded in paper markets. This discrepancy has reached a critical point where the actual demand for gold is outstripping its supply. Yet official market prices do not reflect this. Maguire and other market experts argue that this situation cannot continue indefinitely. At some point, the pressure on the physical gold supply will force a major price adjustment. When this happens, those holding paper gold contracts may find that they cannot redeem them for actual bullion, leading to a panic in the gold markets. Maguire warns that a sudden, overnight revaluation of gold is entirely possible. Historically, major shifts in gold pricing have occurred unexpectedly, leaving those unprepared at a disadvantage. For example, in the 1999 Brown's bottom gold sales, the Bank of England announced the sale of 400 tons of gold when gold prices were at historic lows, around $250 per ounce. However, insiders had prior knowledge of this sale and were able to position themselves advantageously. Today, a similar scenario could play out, where select financial institutions and central banks benefit from gold's revaluation, while retail investors are caught off guard. Maguire suggests that if a gold revaluation happens, it will likely occur over a weekend. When markets reopen, gold prices could be dramatically higher, potentially jumping from $2,000 per ounce to $3,500 or more overnight. Those who hold physical gold will benefit, while those with paper contracts may find themselves unable to take delivery at the new higher prices. While much attention is focused on gold, silver is also experiencing significant structural changes that could lead to a major revaluation. Unlike gold, which is primarily held for investment in central bank reserves, silver has extensive industrial applications. It is a critical component in solar panels, electric vehicles, medical technology, and electronics. Despite its essential role in modern industries, silver remains historically undervalued. The gold-to-silver ratio, which measures how many ounces of silver are needed to equal the value of 1 ounce of gold, currently stands at over 80 to 1. Historically, this ratio has averaged closer to 50 to 1, suggesting that silver is significantly undervalued compared to gold. If a gold revaluation occurs, silver is likely to follow suit, as increased investor demand and industrial shortages drive prices higher. Some analysts believe that silver could reach $100 per ounce or more if the market undergoes a major correction. The time to prepare is now. Investors who recognize these trends early will be in the strongest position to preserve and grow their wealth in the coming years. Gold and silver are not relics of the past. They are the future of financial stability.
And Gatter exploded. You remember this? Gatter exposed the fact that UBS had gone to their clients and said, short gold, sell gold, it's going down, one day before the Bank of England announced 400 odd tons of sales. So anyone who thinks this can't happen, just go back and look what happened there. And the insiders all got the information, were all positioned, and bearing in mind that every single bullion bank that is making a market in the COMEX is also got a footprint in the compliant foreign exchange markets. They will, and bearing in mind that should something happen where you are in the foreign exchange, while you've got a foot in the foreign exchange market and you're long, you're going to benefit from this revaluation because it's not being settled. You're not being squared up in the FX markets. You cannot possibly rig a foreign exchange market. It's a simple cross between the dollar and gold, a dollar and silver, the dollar and the yen, the dollar. You can't just rig it. It has to evolve. So yeah, I think Andy, this can happen. A hard resettlement could happen. I think in the meantime, what tells me that something's going on, that the new administration, and I'd really love to hear more about your Judy Shelton interview, because for me that's gold. But should they decide to do this revaluation?
The financial world is undergoing a seismic shift that most people have yet to recognize. While the first part of this discussion focused on how gold is being revalued through stealth and manipulation, the broader consequences of this revaluation are now becoming clearer. the rapid accumulation of gold by central banks, the ongoing de-dollarization trend, and the potential for a major financial reset all point to one inevitable conclusion. Gold is reclaiming its historical role as the ultimate store of value and foundation for monetary stability. The global financial system has operated on a fiat currency model for decades, where money is backed by confidence rather than tangible assets. The US dollar, as the world's reserve currency, has benefited enormously from this arrangement, allowing the United States to print money, run massive deficits, and finance global conflicts without suffering immediate economic consequences. However, this system is now facing a historic reckoning, as trust in fiat currencies erodes and nations move toward gold-backed alternatives to protect their wealth. The dominance of the US dollar is being challenged on multiple fronts. China, Russia, India, and other BRICS nations have been leading efforts to reduce reliance on the dollar in global trade. These countries are accumulating gold at an unprecedented rate, signaling their intent to transition away from the Western financial system. As the Federal Reserve continues to debase the dollar through excessive money printing and deficit spending, gold is emerging as the preferred hedge against currency collapse. The revaluation of gold is not just about price discovery, it is about a fundamental shift in how money is valued and what constitutes true wealth. In a world where fiat currencies can be printed endlessly, gold remains the one asset that cannot be artificially created. This is why countries with substantial gold reserves are positioning themselves to gain economic and geopolitical leverage in the coming years. The implications of this transition are profound. A gold-backed monetary system would completely reshape global finance, limiting the ability of central banks to manipulate markets and forcing governments to adopt more responsible fiscal policies. This would represent a return to monetary discipline, where economic growth is driven by productivity and real assets rather than debt-fueled speculation. The actions of central banks are one of the biggest indicators of gold's growing importance. While the public remains largely unaware of what is happening, major financial institutions are taking decisive steps to secure physical gold before its revaluation becomes mainstream knowledge. Central banks have been net buyers of gold for over a decade, with 2023 and 2024 seeing record-breaking purchases. The primary reason central banks are hoarding gold is because they see what is coming. They understand that fiat currencies are in a death spiral, and the only way to preserve national wealth is to hold hard assets. The Federal Reserve and the Bank of England have been accused of suppressing gold prices to delay the inevitable, but this strategy can only last for so long. As more nations demand physical gold deliveries rather than paper contracts, the current pricing mechanism will be forced to adjust, likely resulting in a massive surge in gold prices. For years, the COMEX and London Bullion Market Association, LBMA, have functioned as price suppression tools, keeping gold undervalued through the issuance of excessive paper gold contracts. This has created an illusion of ample gold supply, but in reality, the amount of actual deliverable gold is far lower than the volume of contracts traded. Once a critical mass of investors and institutions demand physical delivery, the market will be exposed and gold will have to be repriced to reflect its true value. Gold is not just a financial asset, it is also a geopolitical weapon. Countries that control large gold reserves have a strategic advantage in international trade and financial negotiations. The ongoing economic war between the West and emerging powers is being fought not just through sanctions and trade policies, but through the battle over monetary supremacy. Russia and China have been dumping U.S. treasuries and increasing their gold reserves, preparing for a financial system where the dollar is no longer the dominant reserve currency. The introduction of gold-backed trade settlements and currency agreements is already underway, bypassing the traditional Western banking system. This shift is a direct challenge to U.S. economic hegemony as it reduces demand for the dollar and accelerates its decline. In a future where gold plays a larger role in global finance, nations with large gold reserves will have stronger currencies and greater financial stability. Meanwhile, countries that continue to rely on fiat money will face inflationary crises, capital flight, and declining purchasing power. The United States, despite having one of the largest reported gold reserves, has not conducted a full audit of its gold holdings in decades, raising questions about how much physical gold is actually available. While gold is getting much of the attention, silver is poised for an even bigger revaluation. Unlike gold, which is primarily held for investment and monetary reserves, silver has extensive industrial applications in solar panels, electric vehicles, medical technology, and electronics. As global demand for green energy and advanced technology accelerates, silver is becoming an essential commodity with increasing scarcity. Despite its crucial role in modern industries, silver remains historically undervalued. The gold-to-silver ratio, which typically ranges between 50-to-1 and 80-to-1, currently stands near its historic highs, meaning that silver is significantly underpriced relative to gold. When the gold revaluation occurs, silver is expected to follow, with analysts predicting potential price surges to $100 per ounce or more. For investors, silver represents a unique opportunity to capitalize on both monetary and industrial demand. As gold prices rise and become less accessible to the average investor, silver will likely attract more attention, driving up its value. The physical silver supply is already tight, with major mints and refineries experiencing shortages. This suggests that a silver supply squeeze could further accelerate price gains. Given the inevitability of gold's revaluation, investors must position themselves accordingly. The key is to act before the market fully adjusts. By the time mainstream analysts and institutions acknowledge the shift, gold and silver prices will have already surged, making it harder to acquire these assets at reasonable levels. Owning physical gold and silver is essential, as paper gold and silver contracts are at risk of default in a crisis. Holding physical bullion ensures direct ownership and protection from counterparty risks. Keeping gold and silver in multiple jurisdictions reduces the risk of government intervention or confiscation, with countries like Switzerland, Singapore, and the Cayman Islands offering secure storage options. The potential for a major financial reset is growing. Investors should be ready for scenarios where gold-backed currencies replace fiat systems, impacting everything from savings to global trade. The transition away from fiat currency reliance is accelerating, and those who recognize this shift early will be in the strongest position to protect and grow their wealth. Central banks are accumulating gold. International trade agreements are being settled in commodities rather than paper money, and inflationary pressures are pushing more investors toward tangible assets. The opportunity to acquire gold and silver at current prices will not last forever. As the market adjusts to these new realities, prices could rise significantly, making it more expensive and difficult to acquire these metals in the future. The modern financial system is reaching a tipping point. Debt accumulation, currency devaluation, and inflation are all symptoms of a failing model that has relied too heavily on credit expansion. Gold and silver are emerging as the clear alternatives, offering stability in a world where financial instability is becoming the norm. Those who act now to secure their wealth in tangible assets will be the ones who thrive in the coming years. The time to prepare is now. Stay informed, stay prepared, and, as always, keep stacking.
Stay informed about the latest developments shaping the precious metals market with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.